Psst, psst. You. Hey, you. Yeah, I'm talking to you. Are you tired of the same old podcasts with the same old panels and the same old rhetoric? So am I. So come spend time with me, where you can have a laugh, be entertained, and learn something. I'm your host, Nova, and welcome to School of Thought. Class is in session. Welcome, welcome, welcome to one and all joining us this evening for School of Thought's new Greed, the Financial Markets Edition. I am your teacher, Nova Star, here at School of Thought. We want to welcome you all. And remember to hit the like and the subscribe button. We're going to bring up our panel guest and financial, pretty well, I would say an expert. Yes, Sean Wieland. Welcome in, Sean. How you doing?
Hey, always happy to be here. Thanks for having me.
Happy to have you here. We have several videos that we're going to be looking at today and stuff that you have brought also in order to talk about what we're going to be going into on the financial markets tonight, right?
Absolutely.
Okay, let's get it all queued up. 1 second. I'm having a little technical difficulty. Yeah, baby. All right. Let's see this one right there. You're the good one. It's a long bit.
Good afternoon, everyone, and welcome to Stock Market Today. It's Allie Quorum, and we've got a look.
How's the sound on this, everybody? It sounds kind of low to me.
November 14th, and joining me to break it all down is my colleague Ken Shreve. Ken, what do you have for us today?
Yeah, selling might have picked up the pace a little bit at around 3 p.m. Eastern. That's when Fed Chairman Jerome Powell started talking in a speech. But yeah, we'll take a look at three stocks today. A Brazilian fintech called New Holdings, ticker NU. Also want to take a look at Atlassian, enterprise software leader TEAM. And finally, Sherwin-Williams, a new member in the Dow, along with NVIDIA, ticker for Sherwin-Williams is SHW.
Okay, well, we'll take a look at those three stocks, but first, let's analyze the major indexes. I want to kick things off, Ken, with a look at
all right. Yeah, that is low.
That led on the downside today, finishing down about 1.3% and closing below that gap up day low.
I'm sorry, everybody. I cannot get the sound. I cannot get the sound any higher right now. So let me know if this is doable. If nobody can hear it, then we'll just move on to the extra video
that we saw last Wednesday on the heels of the election. We know that small caps are more volatile, but what's going on here?
Well, they tend to move, with interest rates. What was interesting is that the 10-year Treasury yield was lower for most of the session, and then it paired losses, ended basically flat, on the day. So the move really didn't, small caps lagged, even though interest rates ended mostly unchanged on the day. So obviously a big gap up for the Russell 2000, crosses the 240 level. Doesn't look like a whole lot of institutional selling behind the recent decline here. As you can see, it's just a test of the 10-day moving average, but small caps definitely lagged today. Growth stocks under a lot of selling pressure underneath the surface today. That probably weighed on the Russell 2000 as well.
Yeah.
Let's stop and say hello to the chat for just a moment. Max Extreme, I'm glad that you're here. Unblock me from Instagram. Thank you very much. Romano Productions, P Fledge. We got Sean still in the house. We got Shane. We've got Self-Made. And that's what we've got going on right now.
Look at the tech-heavy NASDAQ and see how that performed today, down about 0.6%. We had been saying how impressive it was, Ken, to see this tight, almost quiet trading action on the index level. We finally did get a little motion downward from that tight trading range, but should investors be concerned at this point, or what should we be thinking here?
Yeah, I mean, I think, we've got a big economic report tomorrow morning, October retail sales. That could move the bond market one way or another. So, at this point, you can see a big move for the NASDAQ in recent days. And this hasn't even, come down to the 19,000 level here. Volume was very heavy in the NASDAQ yesterday. Really didn't give up much ground. So we weren't forced to count a distribution day for the NASDAQ yesterday. So that was a good sign. And volume, as you can see, above average today, but below yesterday's level. So even though maybe it felt like distribution or institutional selling on the NASDAQ today, lower volume did soften the blow a little bit. Still on an uptrend here. Maybe it's going to come down and test these short-term moving averages. We'll see if it does and if it eventually can hold support.
Exactly. So yeah, on the downside, we're going to be looking at 19,000, that 10-day line and the 21-day line and the gap up day low for this index as well.
Yeah, breadth was. I was just going to say, breadth was negative on the Nasdaq today, about 2-to-1 negative, and we've seen breadth in recent days a little bit shaky with decliners kind of having the upper hand over advancers. But one down day, we're not going to lose a lot of sleep. Like I said, the selling in growth stocks has been over the past few days. Even though the indexes haven't moved a whole lot, we have seen growth stocks come under some selling pressure here. So that's something to monitor as well.
Okay, thoughts on the S&P, Ken?
Well, volume.
Sean, you there?
I'm here.
Any thoughts about what they're talking about?
Just that I hate financial news.
I know, right?
Yeah, especially, they're talking about intraday trade or day-to-day trade. And man, that's all noise. If you're trying to do day trading, you're just gambling. And I don't think anybody has a system for that. So it's kind of like, what's the point other than this circular or circle jerk masturbatory, it makes people feel like, oh, I'm financially savvy or I know what's going on with the markets. It's like, but it's trivia. It's not actionable or useful in any real way. So, I think it's meant to appeal to the midwits and retail investors generally. This idea that oh, I'm smart for investing in the market, and people get confirmation bias from that.
Excellent. We'll go back to our video.
It looks like it's going to eventually be pretty close to what we saw yesterday. It's showing pretty light right now, but volume, at least on the homepage of investors.com, looks like it's going to be very close, and it could be even a little higher than what we saw yesterday. So could see a distribution day added to the account for the S&P 500, but too early to tell. We'll need to get that final volume figure. But this index, just like the NASDAQ, holding above short-term support levels, kind of fell below the low from earlier this week, and maybe that is going to bring a test of these short-term moving averages into play. But we'll see how it plays out. And I think tomorrow that retail sales data is going to be an important report for the market to consider.
Okay, and then last but not least, here's a look at the Dow. 44,000, got above it, and now coming back in a little bit, but still well above where we were before last Wednesday.
Yeah, pretty orderly decline here for the Dow. You can see downside volume of the last two sessions on Tuesday and Thursday. Pretty light, lower than some up days that we've seen recently. So the Dow still looks fine here. It remains to be seen if the market's going to kind of move away from growth stocks and maybe move into some of these liquid blue chip names. It's a possibility, but we'll have to just wait and see how things.
Hey, Sean, what is a liquid blue chip? What are they talking about?
So blue chips are basically, large cap, usually large cap dividend bearing publicly traded stocks.
Okay.
Like the top 100 as weighted by market cap.
Okay. All right. Well, that was a better explanation. Me going, what are they talking about? I'm sure somebody else was too.
What they're getting into is, if investors are rotating from growth, which is, it's more speculative, but you're hoping to make bigger gains. And now they're trying to be a little more conservative, and they're going to pivot to kind of the tried and true companies. So they're still going to stay in equities, but they're going to pick the ones that are kind of more established and aren't going to have as much of that volatility. It's kind of like a way of taking profits, except you're going from one type of equity to another.
Thank you for that explanation, Mr. Finance Expert. I appreciate you.
How things shake out here.
Okay. And we do want to take a look at one sector ETF before we move on to the 3 stocks, and that is XLV. It's something that we've seen the relative strength line turn into relative weakness.
God, the
quite
sound
frankly,
is so low.
Since early September, and that has just continued over the last week plus.
Yeah, I mean, if you're thinking about investing in the healthcare sector, the medical sector, even biotech, I was talking with my colleague Dave Chung earlier, and just looking at IBB, the biotech ETF has.
Welcoming in Ken before the storm and Adam, 87. Good to see you again, honey.
Come under a lot of selling pressure. That's a pretty sharp 4-day decline here. That's XBI. There's also IBB, which looks very similar. So whatever area of healthcare that you're looking at, certainly XLV is in quite a downtrend here. Biotechs look pretty tough. There was some news late today that broke, and maybe not a big surprise, that President-elect Trump is likely to nominate Robert Kennedy to the Department of Health and Human Services. So maybe that's what caused the selling in biotech and healthcare today. So we'll just have to see how that plays out.
Yeah. Okay. Well, now let's turn our attention to ticker INU, a wild earnings reaction today.
Okay, because the sound is so low, I'm going to pass on this one, and we're going to queue up the other one. So everybody, forgive me for that. I had no idea it was that low on the playback. So this one is cryptocurrency will make millionaires in 2025. History is repeating.
The Bitcoin price continues to rally as investors front-run Trump's promise of the U.S. Bitcoin strategic stockpile.
Again, it's a whole different paradigm because it forces every other country in. Countries are already buying it. I've got a dear friend, the guy that actually turned me on to Bitcoin in 2013, who's in the Mideast right now, and he said he's never seen anything like it. He's convincing more people to buy Bitcoin in the 3 days he's been there than any time in his whole career. And they're huge pools of capital. And so we're seeing something globally. When Trump advocated in Nashville that he was going to be a crypto president, a Bitcoin president, and now he's the president, let me tell you, other leaders heard that.
Now, the bigger opportunity
They sure did.
may be with altcoins. Watch today's whole video. But again, it seems like every morning we're hitting a new all-time high. Bitcoin surges to new record over $93,000 per coin as strong U.S. demand crushes resistance level. And that continues to be confirmed that literally institutional and Wall Street investors.
Okay, Sean. So are you excited for the all-time high that Bitcoin has been hitting and the prospects? What does that look like to you?
So I think that's expected. If anything, it seems like this cycle, at least according to the stock to flow model, which is the rainbow chart, anybody can Google and pull that up, that, we're entering that next cycle. So yeah, the political juice being added to it might accelerate things, but this was rather expected sooner rather than later, regardless. And yeah, it's exciting to see this continue to develop. I think there is some question this time around that since there are ETFs that claim to be wrappers, all this is flows over pros, right? So it's about where the money flows are going. When you had to actually buy the real asset of Bitcoin, that there's a certain amount of that has to be bid for. ETFs end up kind of creating a shadow version of that, where they're not buying Bitcoin, but they're buying the ETF that supposedly represents Bitcoin. So whether that's creates a softer pressure remains to be seen. And I think it's also a way that Wall Street can start to get their arms back around this, that otherwise was invented basically to escape that system. People who might be interested in buying Bitcoin, well, they're saying, hey, I already have an IRA with some broker dealer. Why not just buy the ETF because it's right there on the platform and it's turnkey? Whereas before, they'd have to do the work of figuring out how do you open, an exchange account at like Coinbase or Kraken or whatever, and get the actual asset. Now, of course, there's always going to be the evangelists out there, and I would agree with them that, hey, there's a big difference between actually owning the asset and owning an IOU or a piece of paper, metaphorically speaking, like an ETF, supposedly representing that, because there's counterparty risk. with ETFs in a way that there is not when you actually own the asset directly. But if people are just speculating until you hit periods of high volatility, most people are probably not going to know the difference anyway. Same kind of thing we saw prelude to with Robinhood, putting it on their platform as well, where you never really owned it. You owned like a claim to it because people were just doing it for speculation and for gambling as opposed to the actual like ownership utility of it.
Yes. And we are not giving financial advice here. We are talking about our own opinions and things that we do here at School of Thought. And we are very crypto friendly here. We're very Bitcoin happy and Cardano heavy hands. Yes, we have heavy Cardano hands over here.
And I think it's two things at once. You have the rise of crypto as an asset class. It's kind of the first thing in a long time where younger people feel like they can get in on the ground floor, whereas a lot of the other investment assets, whether it's real estate or publicly traded securities, the boomers have already ridden that wave up, right? The ERISA created retirement accounts. That's where they're dumping all their savings. They were able to ride a easing credit cycle that their home equity shot up in value. So a lot of the later come to the party generations, even Xers, but millennials and Zoomers, they're showing up when these assets are already at sky high prices, right? So they don't feel like they can actually get any momentum the way that the boomers were able to. Crypto is the first asset in a long time where they feel like they could do that because, boomers don't understand it, or it's magic internet money, or whatever the rationalization is of
they're scared of it.
They're scared of it.
Yeah.
At the same time, boomers don't realize that they are living through an unprecedented social experiment. That ERISA, which is the law that created IRAs and 401ks, was only passed in 1974. That's basically right when they were seriously entering the workforce and convinced to put all their savings into those kinds of accounts to buy these assets. And of course, again, flows over pros. So you have an entire generation dumping all their money into those, pushing up the price, but they're all in their 70s, some are in their 80s now. They've gone from accumulation to distribution. They're selling off those assets rather than buying them up. So those prices are also kind of capped or illiquid, relatively speaking. There's going to be more institutional money that comes into it, but how they're going to get out of that position when all of the younger people are not buying in. Also younger people, they survived 2008. Some of them, watched their parents lose their homes. There's kind of a deep skepticism. Occupy Wall Street was this thing that happened. So there's also kind of like, a political or a cultural angle to it too, that younger people are interested in crypto and the older people need to sell off their traditional finance assets. And, how is that market going to get made? Who are the boomers going to sell to? And especially then once they die off, what is that transition going to look like? So I think you're going to see a lot more interest in how that's going to get bridged between the generations, as well as between traditional finance and the crypto space.
Yeah, I'm pretty interested in watching the turnover and seeing how things are going to transpire from that change of hands. Because it's also the change of hands in as far as like retirement jobs and stuff with the trades and whatnot, because all those retirees are going to make a massive impact into the job market and into the financial market.
Oh, that's a lovely segue into cramming my plug-in. That's exactly what my forthcoming book is about. It's basically every asset that's important to boomers is one that, because they won't let the price fall, they won't allow new entrants in. They're creating artificial scarcity to keep the prices artificially high to preserve that notional value. The trade-off is it's illiquid. So a very simple analogy would be something like a certificate of deposit at a bank, a CD, as opposed to a checking account. You would get higher interest, you get higher value for it, but you lose liquidity. And that's the trade-off. And because it's all on paper and they're taking small distributions, they don't notice that loss of liquidity. But if there's periods of high volatility, another black swan event or something like that, they could find out very quickly that they're not able to get out of this position as much as they would need to preserve how much they think they have on paper. There's a big difference between like notional value and actual value.
Absolutely. Paper always looks better. Well, sometimes.
As long as nobody touches it.
As long as nobody.
It's like a pyramid scheme. If nobody makes withdrawals, it looks great.
Very true.
Investors are buying hundreds of millions, if not billions, of dollars per day of Bitcoin. And keep in mind, pullbacks are part of any bull market. We are not going to see green candles forever, but with every 2 steps back, we seemingly go 3 steps forward, and 500K eventually is baked in.
Mike, how soon do you get to 500,000? That's kind of a stunning level to think about, but we're probably going to hit $100,000 this year if we keep on going at this rate.
Yeah. So listen, the total market cap of gold, I think, is like 16 trillion, right? And so that's 800,000 Bitcoin. So when does Bitcoin become gold? Like, there's a new generation that cares more about Bitcoin than they care about gold. I'm turning 60 next week. And so I still own a bunch of gold. I'm an old guy, but let me tell you, no 40-year-olds on gold, no 30-year-olds on. And so as we see this generational shift, like Bitcoin should match gold within 5 or 10 years. And that gets you to 800,000. That's with current gold prices. I think gold's going higher.
So understanding that this Bitcoin rally is just getting started, yet pullbacks can happen. Investing in cryptocurrency comes with risk. Do not invest more than you're willing to lose immediately. Investors will be getting rich in this market. And in a way, history is repeating. So let's talk about altcoins. Let me share with you the specific coins making moves. But the Bitcoin rally thus far is par for the course with Bitcoin's prior cycles. I know it feels like this time is different, but BTC is still just tracking its prior cycles. Of course, there will be deviations, but this is the big picture view. So this is showing the ROI, return on investment, from all Bitcoin market cycle bottoms. So Bitcoin throughout history has gone through 4-year cycles, this driven fundamentally by Bitcoin's halving, the supply shock. And looking at where we are today, market cycle 5 in the purple, while yes, earlier in the year.
And it's pushing all my altcoins. Push my altcoins, baby. That's right. Push it.
During the Bitcoin halving, we popped off a little early. ROI today is exactly where we should be, with the most explosive part of the Bitcoin ROI yet to come, if history repeats. And which altcoins are making news? Well, BlackRock expands its tokenized fund BUIDL beyond Ethereum to 5 new blockchains. The investing giant is bringing its RWA real-world asset fund to Aptos, Arbitrum, Avalanche, Optimism's OP mainnet, and Polygon. So obviously this will lead to more activity, more use of these blockchains. But just a reminder of what BlackRock's tokenized fund BUIDL is. It's like any other money market fund in traditional finance, only this one's.
Let's read Uncle Gun's comment. I still don't see how gold and silver is still a thing. Only 4% growth over its lifetime record. Yawn. I agree with you. I'd kind of like to also know why platinum is so much lower than good old inflated gold.
So something to keep in mind there, and we're going to touch on this later when we get to one of the videos I sent in. Okay. Is that sequence of returns is the important thing to look at. Mm-hmm. So what the duration that you're looking at. So if you're saying since inception, or even since the beginning of the stock market, like say 100 years ago, that's different than I'm trying to think where I go with that, but like the future is not necessarily going to look like the past, right? Like yes. It's a question of how you're allocating it to those assets and for what purpose, basically. So, in periods when risk on assets are doing poorly, commodities in general tend to be a relative safe haven, and gold, for historic reasons of, gold as money and central banks owning gold as reserves, tends to be one of the prominent ones.
Excellent. Appreciate that that explanation, sir. All right, back to our video.
Tokenized and how this affects Ondo, because as we know, Ondo is being utilized and in collaboration with them. Well, as stated by Ondo, we are delighted to support BlackRock and Securitize with their multi-chain expansion. Ondo's OUSG stablecoin is backed by and the largest holder of BlackRock's BUIDL, and we intend to diversify our BUIDL reserves across a variety of supported blockchains to facilitate liquidity across more. So pay attention to the cryptos that the elites are working with. But in lower cap altcoin news, the Spotify killer, Tune FM, wants to take on Spotify by using crypto to pay artists up to 100 times more per stream. So I loved this highlight.
Oh, nothing wrong with that.
Massive audience. That why are we still using Web 2 platforms like Spotify, like Apple Music, which don't pay their artists, but also don't give users any control? There's a better option out there, and TechCrunch is highlighting that. Unlike any of the other big streaming services, Tune FM is a decentralized music streaming platform that runs on the rails of Web3. And this is not a subscription model, but users actually pay for each song they stream using the company's own Jam tokens. And you can also stream and earn. Users can also choose to listen to promoted music and earn more Jam tokens. And this is not just in concept phase. This is live today.
So a new version of a jukebox. Okay, got it.
Well, so I'll comment on that, this is a point that Elon has brought up. Anyone who has read Trust Me, I'm Lying by, what's his name? He has like one of those superhero names. I know, dead air. Ryan Holiday. And we'll get into this when I talk more about my background as well, but working in the .com era in the 90s, there was this perception that everything is going to be free because advertising is going to pay for it. There was a point in the late 90s where they were giving people computers with the idea that the computers were going to run ads that people would have to watch as they're using the computer, right? Like, what can't ads pay for? And then as that developed into Web 2.0, and especially with big tech and social media, what we've seen is, well, if you're not paying for the product, you are the product. That all of this so-called free stuff is not just about advertising, but it's really about these detailed consumer profiles that they sell to advertisers that are far more invasive than anything any three-letter spy agency has ever done to look at your life. I mean, they'll practically can predict what you're going to have for breakfast the next day, right? Because they just have access to that, so much of that raw data, and most people are actually pretty creatures of habit and predictable, what they call pattern of life analysis. Okay. So that transition and what Elon points out. So, Elon was complaining about the lack of free speech in big tech and how they were censoring it. Buys Twitter, wants it to be a free speech platform, and then all of these advertisers pull out, and that's meant to be a threat. Like, hey, you play ball, or we're not going to give you the patronage money. To fulfill our agenda, right? And he's pointing out that, well, that's not what the user base wants. That's what this managerial elite of advertisers want to synthesize. Public opinion is always manufactured. It's public opinion is always imposed. It's never it's never a reflection. It's manufactured. And Ryan Holiday goes into this in his book as well, that the way you fix that is a subscription model. And this is why Elon wants people to pay, what is it, $10 a month or whatever to subscribe to Premium Plus for Twitter. Is if you have enough base of people who pay to actually use the service, you're not entirely dependent on advertising in order to run the business. So it's kind of one of those, like, what's old is new again things. But being able to pivot to people, finding a convenient way for people to pay for what they use and not have to have it be quote unquote free. And really what you're selling is the data mining on every little, all your listening habits and everything about you. And then also that people are then using that to target you and shape what you think and what you like. It helps break us out of that cycle. So some version of that, I don't know if this is going to be the one for Spotify, but if we can, in general, make that transition, that also creates a much healthier ecosystem for everyone.
Agreed. Adam87 says, natural resources versus digital numbers. What has real value? Welcome in, Michael. He also says, all investments are about either growth or hedging against the inflation of a currency-based system, because you can only store so much food and ammo, and not everybody needs us from you at a notice.
You can stream Beyonce songs, mainstream artists, and indie artist songs, and artists receive instant payment, earn 10 to 100 times more than Spotify, our cutting-edge technology delivers micropayments at the rate of 1 penny per minute streamed. And that is so much more money than they would get from a Spotify, which pays 0.003 to 0.005 per stream, or Apple Music, which pays 0.01 per stream, and also has built-in UX UI for NFTs and other music collectibles. Actually, I want to thank TuneFM for partnering up today and making this section of the video possible. You can join right now and get music. They do have, again, a Web3
AI plays a huge.
You want me to just get past that part?
better. Listen to the founder explain how they're using AI to give you a better experience.
AI plays a huge role in discovery. We have a lot of features with AI, like recommended songs, which are based on your music taste. And we use the user data of what music they're listening to and what they like and where they spend time to train on that data to create a music taste profile where we're able to serve up recommended music. You might find on Spotify, it's giving you the same rotation of the same few dozen songs all the time, and it's hard to break out of the algorithm because it's actually not that advanced of an algorithm. With TuneFM, it's way more advanced, so it can find things all over. And then you'll be able to put in stuff like play me music for a nice summer day or for a workout and be very specific with your prompt in the same way that ChatGPT works or AI image generation, but it's serving up music instead of images or text.
So if you like music, start streaming today and link down below to claim 1,000 Jam tokens. And why is Dogecoin rallying? Well, President-elect Trump appoints Elon Musk and Vivek Ramaswamy to lead the DOGE, the Department of Government Efficiency.
But how tied is this to Elon Musk? I mean, Department of Government Efficiency, DOGE.
This rally we've seen, I think, is almost, completely tied to Elon Musk. I mean,
This has nothing to do with Dogecoin offhand, other than Elon named this agency Doge.
You start with the notion of sort of market beta, and the same is true in the stock market. When the S&P moves a certain percent, there are certain stocks that move a lot more than that. So Doge is starting from that layer, as are a lot of smaller meme coins. If Bitcoin's up, they're gonna be up a lot more. If it's down, they're gonna be down a lot more. But you cannot, sort of ignore the Musk connection here. Elon Musk has been a huge champion of Dogecoin, mainly, I think, just for the memes. The guy likes funny memes on the internet. Dogecoin is sort of the, meme coin of choice on X and Twitter before that. So it's hard to know exactly, if that's as far as Musk's appreciation for it goes. But regardless, crypto is all about speculation. He likes it. He's got the ear of the president. It's up almost 200% since the election.
Now, for those of you...
Boy, all the Doge fans out there, you've gotten quite the nice little boost since Trump has reclaimed his place. Enjoy the run. What do you think about Doge, John?
I think Elon really understands the power of memes. It's not just entertainment, but he's part of the PayPal mafia. Peter Thiel has spoken often about Rene Girard and the power of mimesis, and people's desires are often manufactured, or they covet what they see around them rather than it being born from inside of them as like inspiration. And Elon has been very skilled at walking that line of free speech in his Twitter account. That also happens to rally large crowds of people that do end up doing things that happen to also be very good for him financially. Whether that's just free speech or market manipulation, kind of exposes that's almost like a false dichotomy or impossible to distinguish between the two. So I think the whole Doge thing is part of that he understands that that's a powerful symbol. It's something that people are familiar with. He can push that ball further down the field and use it, and that that mimetic power of a familiar symbol is something that's going to give him a lot of capabilities as a leader.
Oh yeah, it gives him a lot of favor too. A lot of people will swing in that direction. It's a familiarity, and it's kind of a comfort too, because it's been around for so long. So
using Margex and are
What did you want to say? I'm sorry.
Oh, no, it's fine. So the only other thing is the guy commented, everything about crypto is speculation. Everything about investing, as most people understand it, I mean, unless you're actually buying a dry cleaners or a steel foundry or a farm, is speculation. If you're buying if you're buying S&P 500 index fund, that's also speculative. So the idea that crypto is somehow an exception to that is a false dichotomy. If any of the stuff that people are trying to trade on momentum, that's speculation.
I agree with you 100%.
On Dogecoin, or if you think Dogecoin topped in the short term and you're shorting Dogecoin, I will put a link down below. Be sure to use code altcoin. There's up to $10,000 in bonuses just for trading anyway. Just always be sure to play it safe. And if you're not in an active trade, take your money off exchanges. You do not want to lose access to your coins if any centralized exchange has problems. Also, major piece of news for Hello Labs and show Killer Whales, which we're producers and judges on. Meet the Whales.
Hey, I'm Aaron Arnold.
Austin Arnold.
Founders of Altcoin Daily.
The largest crypto YouTube channel in the US, Altcoin Daily, made it to over 1 million subscribers by posting a video every single day for the last 7 years.
Wow.
The Netflix of crypto gaming. That spoke to me. So for me, it's a swim.
I'm rooting for you, but here's the thing. I think you're a little bit unfocused. I hope someday you come back here and say, I told you, Aaron, I could make it, and this is it. But for me, it's a sink.
I really hope you support me. Watch this season 2 dropping early 2025. This is going to be such a great show. I will keep you updated. Also,
Well, that was interesting, and a series. It's kind of like Shark Tank, but crypto style or something, right?
So, this kind of exemplifies that smart money is on selling pickaxes in a gold rush, right? So rather than necessarily directly speculating on the movement of these assets, they're trying to figure out, okay, how can we create things that other people will find valuable within this ecosystem? I think there's a bit where this gets a little, navel gazing, I guess, when it's, podcast and entertainment. And yes, I appreciate the irony of saying that on a podcast. But there has to hopefully be more, and hopefully there's going to be valuable takeaway for everybody watching this, beyond just entertainment, that there's also going to be actionable information that's going to help them in their daily lives.
Yes, very much so in their daily lives. Let's see. Michael just made an interesting comment. Doge is a huge pump and dump. It's unlimited in supply and a function right now of temporary optimism and the last bit of market liquidity. But if somebody is a big fan of it, they're not going to pull away from it. Truly, they really won't.
Each year, James, I know that this will not be liked by perhaps some independents who think that they rely on donation money to get over the line, but there is definitely an argument that the less influence of outside forces in politics, the better.
Look, it's very difficult for me to comment on this in terms that we in the coalition are yet to see the final bill. It hasn't been introduced into the parliament, and it'll need to go through our shadow cabinet processes and go through the process of the party room. But any change to how we govern our elections in Australia need to ensure that neither side is advantaged. We need to make sure there is transparency, and we need to make sure that the voters are empowered, and that those secret interests, especially Mr. Simon Holmes of Court and all those secret backers of the Teal movement, are certainly held to account.
Do you think, Terry, that it does have the potential to disadvantage independents and small parties?
Well, I agree with James about not having the detail, Caleb, but yes, look, I think there is an issue here. I think one of the issues that we have to have a conversation about as a country, I think, is the cost of our election campaigns, the cost of standing for parliament, the cost for good people to stand for parliament. whether
That's
they're in a
true.
party or independents. Look, I think the real issue here for me is I don't really care about billionaires. A pool of them and their money are often soon parted. As long as there is full transparency and disclosure in real time, and that effectively we know where that money is coming from. But the other thing, and James is right about getting the balance right, because while the Labor Party's unions and their mates are still being able to funnel money into the Labor Party, into Labor campaigns, there's always going to be a disadvantage there that the coalition has struggled to even try and match.
Yeah, correct. Why don't we just swap out donations for just Qantas upgrades for everyone? Let's see how that goes. Now, you might remember...
Oh, come, sir. You're going to hurt all the lobbyists' feelings by limiting all those donations. What do you think, Sean?
So it's the iron law of oligarchy. You know, democracy is always fake and gay. So, you know, like that famous Stalin quote, if it's not the votes that count, but who counts the votes? The voting doesn't scale. There's always going to be people who have to organize the town meetings and who's going to be on the ballots and when there's going to be commercials and all of that infrastructure. They've then become the gatekeepers and the real locus of power. So to identify political contributions as if it's an exception to that, that's just par for the course. I mean, that's how the system is necessarily designed. So if you're going to be critical of that, you know, maybe that could be your first step to being disillusioned with democracy in general, that like it can't actually, you know, sustain itself in the fairy tale way that people are sold on it.
True. Michael says, my personal bet for the next 4 to 8 year cycle is stocks, bonds, and real estate fall or melt up relative to commodities, but that's just me.
The former South Australian opposition leader David Spears, he had to resign from politics recently after he was charged with supplying drugs. Well, the Liberal candidate who's running to replace him at a by-election this weekend says that we should have mandatory drug testing for politicians. Amanda Wilson, she believes that random drug testing would increase people's confidence in politicians. She says a lot of other people in the workforce have to submit to drug testing, and politicians are making legislation. They should be held to a higher standard. James, would you be happy to subject yourself to random mandatory drug tests?
Oh, mercy.
I would be happy to submit myself to random drug tests. But actually what we do need is politicians with common sense. So we should have a test for common sense, because I'm pretty sure Anthony Albanese is neither drunk nor high on drugs, but a lot of the decisions he makes look like they're made by someone who is drunk or high on drugs. So we need more politicians with common sense.
If only there was really a test for normality and basic sense. Yeah, great.
Well, that's the whole biological Leninism argument, that the incompetent people are naturally drawn to politics because it's a field where you can bullshit for a living as opposed to actually having to be good at something. So, you know, that's why it attracts people like Kamala. It's, you know, they literally can't do anything else. And they found their niche of, well, I can, you know, fake a persona for a little bit and convince people to buy it. And the loyalty that comes from within a political party or a political organ as well is also then what sustains it, that they're good at rallying the wagons. And so instead of competency, they succeed because of loyalty, which is exactly how the Communist Party in the Soviet Union worked. You know, there were all these peasants who were well out of their depth and really had no idea how anything worked. But because they had that solidarity, they were able to stay in power.
Yeah, it's basically going to Hustlers University. That's what you're describing.
Something like that. Yeah, exactly.
Yeah, pretty much.
What do you reckon, Terry? I mean, you know, you might have to. If they had like an alcohol test, you'd have half the parliament banned from ever entering the building. But how about drug tests?
Well, certainly on Wednesday night when Parliament gets up early, but certainly in my day working in Parliament, there was never much time outside of that for drinking or drugging. But certainly, I think. If other occupations, other industries need drug testing or have random drug testing, and politicians who make legislation, whether it's state or federal, actually mandate these sorts of things. They should be subject to it themselves.
Now, you'd like to think that the people administering Year 12 exams would know.
Well, I would say drug testing for politicians would be great and all, but they would just lie about the test results anyways, so what's it matter? That's just my personal take on it. What do you think, Sean?
So, this is just something that's going to be weaponized. There's no such thing as equality under the law. Laws are selectively enforced all the time. You talk to any prosecutor and they'll openly tell you, and, police officers, as far as who they stop and who they don't, is, at their discretion. So this idea of drug tests and pitching it as if it's something that's going to be applied equally to everybody, that's the trick that they're pulling off, is what would really happen. And same with like IRS audits in the United States. It's funny how it's the political enemies that suddenly are faced with a bunch of audits, right? Or, would suddenly be under that kind of scrutiny, or, the SEC going after Elon Musk, right? So, they pitch it like, oh, this is about fairness and equality, but really what they're asking for is to be given another political weapon. And politics is, in the, Schmittian sense, it's always just about rewarding your friends and punishing your enemies. That's what defines the political. So that's all they're really asking for.
Yes, nepotism at its finest.
What they're doing, but how bad is this story out of Victoria? At least 3 exams have been compromised. The Victorian Curriculum and Assessment Authority has admitted that entire parts, or at least very similar parts of the exams, were accidentally included in the instruction booklets for business management, specialist maths and legal studies exams, which has effectively allowed students to cheat. The Herald Sun reported that the authority discovered the issue in mid-October after being alerted that students had been sharing online how they were able to highlight blank spaces on pages of booklets, which, when pasted into Word documents, revealed hidden questions and case studies. Terry, you're down in Victoria. Who's running the show? I mean, if the people who administer the exams can't even get the exams right, how bad is that?
Well, if there's a choice between a cock-up and a conspiracy, go for a cock-up in Victoria every time, because we have cock-ups left, right and centre, and this is just one of them. Look, I'm not tech savvy, so I'd never be able to get away with actually trying to do that. But the fact that the kids were able to do that and preparing for their BCE or HSC exam just beggars belief. I mean, back in my day, we didn't have all this fancy stuff. We had to use old HSC exam papers to practice on. It wouldn't have happened. But certainly, I think when it comes to Victoria, it's not a state of excitement anymore. It's a state of absolute cock-up.
Yep, and even though we've had a laugh about it, it is actually serious, because there are kids now who potentially could have their exams thrown out because of all of this. This is serious stuff for a kid trying to leave at the end of Year 12. James, Terry, thank you so much for your time.
Sean, you there?
You're muted. There you go.
Oh, there I am. Okay. I think I accidentally hit that with my wrist. Sorry about that. So did you have any final thoughts on that video?
Only that, it's that managerialism issue of, they're complaining that the kids are working around the test, and all that says is that it's a bad test. But of course they're not considering that. They're considering, how do we stop this so that people have to fit within the box that we've created? And,
yes.
Really what it is you've got to throw that box out, because it doesn't, if it ever did work, it doesn't work anymore.
I agree with you on that one. So tell us about yourself and give us a little bit of your backstory and how you became your superhero self. Give us your superhero backstory.
Okay. should I start this like Putin, as the sun went nova and the earth cooled and Pangea formed. So
yes, which is better than my story. My parents kicked over a rock and there I was. I'm just kidding.
So professionally, my background originally was in computer engineering. I was in the early 90s part of the cypherpunk mailing list that Ryan Lackey set up. So a lot of this like crypto stuff is very long in the tooth for me. Then worked for a .com that was one of probably a dozen companies that could have been YouTube and just wasn't. And, sometimes that's just luck or fate. But how we started out was focusing on live band recordings. And then we were sending out emails to advertise basically for ticket sales and then getting a percentage of that ticket money. So kind of like, maybe hoping to be bought out by Ticketmaster or something like that. But part of working in a .com as a software engineer, and also I was familiar, MP3 was becoming a big thing at that time, and I was intimately familiar with the codec, and they were having a problem getting that to scale with the amount of content they were getting in. So I was in charge of designing a system that could encode audio and video in a way that could scale with the amount of use that we were getting. And also, like, video was very new at the time. I mean, this is like when most people are watching video on the internet with Real Player, if there's any other old heads who remember that. So
are we talking early like MTV days type thing or what?
Well, so this would be late 90s and early 2000s, and then the .com crash happened. But I'd always been interested in finance also because this was the great moderation was underway. People were making a lot of money in the .com boom. You could finally buy stock from at home, which is another reason kind of why the retail market exploded is, you didn't have to go to your stockbroker at Sears. You could just log into your AOL or CompuServe or the internet and E-Trade had become a thing. So that also helped to push up a lot of those sales as that retail investing became a lot more accessible. But also just the nature of IPOs. Everybody was getting very wealthy from going public at the time. So that aspect of it was very interesting to me as well. The .com crash happened. Basically, any of the coding jobs that remained were kind of the code monkey jobs that were all being offshored. The prospects in that field weren't very good. So everybody pivoted to finance, which I didn't realize at the time. I thought that was kind of a decision that I had made. But looking back in hindsight, you can see that all of the money that used to be in tech pivoted to Wall Street. And of course, that's when you had the big 2000s boom, also because interest rates were being cut to fund the global war on terror. Yes. Which of course created this giant bubble that then crashed in 2008. So that's the sort of how I went from engineering and computers, and I still bring kind of that engineer's mind to the problem of investing and how all this stuff works. But that moved to finance, because that's where the money is, right? Who was it who said, well, why do you rob banks? Well, that's where they keep the money. So
that's where all the treasure and the booty is.
The booty.
The booty.
So through a friend of a friend, was solicited because my friends had known that I was kind of doing this stuff on my own for myself for a while. That hey, why don't you just get the licenses and be able to do it for others and give that kind of advice. Worked for a firm for I don't know, over 5 years or something like that. And then, so then this was around the Obama regime. He was threatening towards the end to put in what's been called the DOL rule. Basically, there's been this trend of pushing for indexing in general. The way that FSA accounts work in the government is like you get to choose from these 6 flavors of ice cream, and it's a mix from like 100% bonds to 100% stocks and 20% gradations, and that's all the options that they give you. And that those kind of this is also like when nudge they had the nudge unit in the Obama regime, right? This idea of like, well, people don't make good decisions. We're the experts because we're the managerial regime or the managerial state. So we need to coerce gently, a softer, kinder totalitarianism to have people make the right decisions, which of course they know what the right decisions are. And if everybody else does something differently, it's because they're stupid and, obviously they're so smart. London actually went through this. They implemented this, and the amount of advisors absolutely plummeted. That basically, unless you could afford a family office and have £100 million, you can't get a financial advisor in the same way that you can in the United States. Now that DOL didn't go through. Trump voided it when he became president the first time of the 3 times. But nevertheless, it's that forward guidance phenomenon of people start preparing for changes that are expected even before the changes have gone through. So the industry was already restructuring compensation models and payout and kind of the focus and the way they were doing things. Even regardless of the fact that rule didn't go through formally, like the industry had already lurched so much in that direction to prepare for it, that it really was not, it was too locked down and what do they call that? Soldier proof or dummy proof? Why they call it, an advisor became less and less apparent, because again, it's that mentality of a group of experts already, they think they know the best way to do everything. And they think the issue is just about relationships and communication and, making the poor dumb saps out there who don't know any better to convince them that this expert's way of doing things is, of course, the right way of doing it. So kind of like the difference between being a scientist and a science communicator, right? So I didn't care for that. Having had that amount of time in the industry, so the finance industry is kind of bifurcated between broker dealers and registered investment advisories. The latter is more about placing product, or the former is more about placing product, and the latter, the RIAs, are more about they get paid basically just on the advice. And because they had that fiduciary responsibility, and I've always had it, whereas broker dealers did not. There was a lot more flexibility, and it was more the way that things used to be. It's kind of like a nice niche to be in that had not yet had the eye of Sauron on it to ruin it. Okay. So ended up opening up my own RIA, gave me that flexibility, focused on exit planning with the anticipation that boomers were retiring. They're the ones who own all these assets. They have all these businesses. Eventually they're going to get old and sick, and they're going to need to sell them. And the business is the most significant asset that a business owner owns. And they probably haven't done any planning to prepare that business for sale. Now it turns out years later that boomers have no sense of legacy. They think they're never going to die. They hold on to power like grim death and are terrified of handing it over to anybody else. Basically, the world ends with them. So
you just said a mouthful right there.
Like Tim Dillon is very good on this too. I joke that I just have to get my book published before he does because we both talk about this, but it's a race to see who actually gets it online first. But yeah, they think, and so it's like Dianne Feinstein, right? Where they're like wheeling her in a wheelchair to vote, or Jimmy Carter voting. And he's like a corpse, right? But he's voting. Okay,
just prop his arm up and it'll tend to right. Don't worry.
It's like that meme of in Brazil where the sugar baby is wheeling in some old man because they need a thumbprint to withdraw money from the ATM. It's like, is this really his decision, or is this just elder abuse? Or even looking at what they did with Biden, right? Please leave this old man alone. No matter what crimes you think he's guilty of, he's a shell of a human being at this point, and to just trot him out and make him go through this stuff is, I don't know, evil. So now
they're just a corpse for hire. Don't feel bad for them. Don't worry about it.
I know. Yeah, I don't feel too
just
bad.
Don't worry about it.
They're evil, child predator people. So
Joe Cool. Hi, Joe Cool. Welcome in.
So I've taken some time away from that and to focus on finish writing this book, which has been in the works for a few years now, and I got about 2/3 of it done. But I have a buddy of mine who's an editor, and we just kind of got to get it. It's like that last 5% is the hardest part.
Yeah, it is.
But yeah, so boomers have any asset that is valuable to them, they've basically made completely illiquid because they're terrified of losing its value on paper, especially because they went through 2008 as well. Like 2008 is this, like, I hate to use a phrase like generational trauma, but it really across the board screwed everybody's deep psyche in ways that I think we still don't really admit to ourselves. For the boomers, it's that they fear that they can never really retire, and they're the wealthy. I mean, anybody else after them and their savings rate, it's like there's no way they're ever retiring, right? But boomers have this expectation, hey, they were really promised, because again, ERISA passed in 1974, the ability, hey, put all your money in the market and then it's going to be there for you to generate income when you retire. And 2008, I think, was kind of this rug pull that they once bitten, twice shy, and they never really want to give up their job or their income or their position.
True.
Because they don't really trust that that's going to be there when they need it. Same way as a Gen Xer, Social Security is not going to be there by the time I need it, right? So like, why am I paying into this thing I'm never going to get? But as a result, it really, that focus on keeping stock prices high, instead of paying qualified people or hiring new, young blood to be qualified and invent things. Like, the mass psychology distortion that comes from a gerontocracy is very similar to what happened in the Soviet Union, right? That, like, they knew how they got into power. Stalin circled even after Stalin was gone. So like Khrushchev or Brezhnev, they certainly were never going to give up power, because they, then you're going to end up in a gulag, right?
Yeah.
And boomers very much feel like that same way, but it just distorts all the incentives that, like, being able to afford anything. All lending has become predicated on collateralization. So basically, it's a catch-22 of, unless you own assets, you'll never get a loan to buy more assets. And the only people who really own those assets are the boomers, who are able to, first of all, they had government programs that got them that foothold to begin with, unlike everybody
sure
else.
did.
They pulled the ladder up behind them. But also now that's become this reinforcing thing that, basically they don't want those other people to be able to horn in on their racket, because they're so desperate to hold on to what they have. And it's reflected then in the rest of industry as well. That's why we have, what Peter Thiel calls the great stagnation, or, even on the left, they call it the slow cancellation of the future. That the 1990s were just, last decade, right? Oh, wait, no, it's 30 years ago, but it feels like 10 or less, because, we've got faster internet and faster computers now, but otherwise, everything else about the culture and technology, and we have smartphones, but mostly things are pretty stagnant. Like, things are not really any different than they were. Whereas if you think about previous decades, the 80s, the 70s, the 60s, the 50s, I think we're farther from when Back to the Future came out than when Marty in Back to the Future went back to the 1950s, right? Like, that's this whole boomer, boomer truth regime movie about, wow, look how different it was, in the 1950s compared to the 1980s. I think it's also a way they can retcon their own history, that, like, let's pretend that those mistakes we made in the 60s and 70s didn't happen. We're all wholesome now in the 80s like we were in the 50s. We're just going to pretend how we ruined society.
Let's just erase those recessions.
Yeah, well,
there's nothing to see here.
But we're further, the distance is further for us, and yet, if any of us went back to the 1990s, other than we'd be complaining about dial-up internet and that our phones are flip phones, life really would not be that different. We'd basically be watching same TV shows and movies and having similar kinds of conversations. So, and that's because since 2008, and also because of the response to 2008 with, oh no, I'm spacing out on the term. But basically how they got bailed out. Is that you've got all this zombie capital, right? Like, they were not allowed to fail. They were, they were able to be paid anyway. And because it's all to sustain this target, Goodhart's law of when a measure becomes a target, it ceases to be a useful measure. And that's basically what's happened to the economy, as well as, because of the boomers, that the economy, people now think of the economy as Wall Street and the S&P 500. As opposed to like PMI or ISM, like manufacturing capacity, right? And instead of making things, we just make spreadsheet assets.
Yes. Michael says, preach it, Sean. He also said something, I'm going to direct it at you. The boomer issue is there's simply not enough young people with money to buy their investments at a fair value, so they will need to take a hit in terms of real purchasing power due to demographics.
Yeah, so, a little foreshadowing to my book. I'm not going to charge hardly anything for it, so I can give away some of the secret sauce here. But what's very likely to happen is very much how mortgage-backed securities did a gated sell-off with Maiden Lane as a special purpose vehicle. So unlike the Bank of Japan, the Federal Reserve is not supposed to be able to own assets that do not originate from the government, namely treasuries. They, due to a crisis, again, because sovereign is he who decides the state of exception. So whenever there's a crisis, the rules go out the window and people just make it up. That's the nature of political power always.
Yes,
law and constitutions are all post hoc rationalizations. So during the crisis, they created Maiden Lane as a special purpose vehicle. And basically the government, the regulators at the time, and everybody went along with this, is one, well, if we create a special purpose vehicle, an entity that is, the government created it. Oh, well, now that's a government asset because they created this entity. So that makes it okay. That's like the cover story. And then the other argument too is, well, we're taking on these mortgage-backed securities. Yeah, they may not have originated as government assets as treasuries, but they're government guaranteed. They're through government-sponsored entities, as GSEs. So they're already kind of quasi-government. And again, this reveals how the managerial state works, a private-public partnership that, not only is it all the 3-letter, 4-letter agencies in the executive branch who are totally unelected and the permanent bureaucracy, but then it's also the heads of all these publicly traded companies, and it's a rotation between the two. Everybody complains about the military-industrial complex and that you work in the Pentagon and then you go work for Lockheed Martin, but that's not limited to that. That happens in healthcare, drug industry, obviously. But even just like really mundane thing, communications, basically, and they all go to the same schools and they all get the same degrees and they're all raised and they all hang out in the same social circles. George Carlin has a really good bit on this of, you don't need a formal conspiracy when everybody already kind of agrees on the right way to do things, right? They've been trained and their whole social circle
This is their way.
knows this is how it's supposed to work, right?
And their way is the right way, always.
Right.
Yeah.
So that, so like with the lockdowns, right? It's no coincidence that the big Fortune 500 companies, the publicly traded companies and the big government agencies basically had the same response, implemented the same procedures, and who didn't was privately held small businesses who actually depend on profits and not just stock buybacks to generate income, and said, no, we've got to actually do stuff and make profit and make a living in order to survive.
Yes.
Now, the managerial state, I think, also saw it as an opportunity to, well, that's the competition, right? Those are the outliers who don't fall in line and don't get with the program. This is a very convenient opportunity to get rid of as many of those as we can.
Yeah.
Because they're the, they're the uncle who says inappropriate things at the house at the Thanksgiving dinner, right?
Yeah.
They're the ones
it's the weird uncle. Everybody's got one.
Right.
Well, I have a question. I want to reel you back for just a second because we segued so quickly away. So this book is due out when, and what is the name of it?
So hopefully by the end of the year, I joke that before Tim Dillon publishes his book, Death by Boomers, it's primarily about this phenomenon of the boomer generation because they need to keep all the assets that define their wealth and status artificially high, have made the markets for that illiquid. So there's a trade-off, right? You can't have both. So if you're gonna keep prices high, it means that the market is thinly traded.
Yes. What is the name of Sean? What's the name of the book, honey?
Oh, then so tentatively as of now, it's Ice 9, like the Kurt Vonnegut Jr.
Okay, so Ice 9. And where can people find this book?
So I'm just going to publish it through Amazon. It'll be available as a Kindle, and then they do print on demand. That's way better than working through a publisher. I've known too many people who've written books through publishers, and it's a completely opaque process that takes forever. And even if you get a good advance, it's never really worth it in the long run. You can you can make, and again, it's not like I'm going to
Awesome.
charge out for this.
Okay,
Yep.
so we are going to start putting in the link for when your book is ready for purchase. And how many books have you written, Sean?
So this is the first full book. I've written articles and done other podcast episodes and stuff like that. But yeah, this is going to be the first, full length book.
Do you have an open blog that anybody can go and find you at?
I do. I'll put it in the show notes after this. I have to pull up the link. Yep.
Okay.
It's a Substack.
That is
Like
awesome.
everybody. Yep.
That's awesome. And so the way you speak, you're very passionate about finance and the markets and stuff. Would you say that you have a real passion and love for doing this type of work?
So to bring it back maybe a little bit about my origin story. So that the common thread in everything I've ever done in life is complex systems and pattern recognition. So whether it's the technology side or the finance side, it's more how do all of these pieces interact and what are the second and third order effects of what people do. And most people are shockingly bad at understanding knock-on effects. So thinking those things through is where I feel like I have the biggest advantage as far as like natural talent.
Well, I would say that you have talent there. Well, we look forward to seeing your book coming out. Now, did you want to also elaborate any more on what was that term that you called it earlier? Hedging the entrepreneurial risk and why ERISA plans don't help diversify or protect savings.
Yeah, so I guess we didn't. If we didn't have the video up, that's fine. So
no, we're going to play the video. Okay, I just wanted to give you a chance to recap anything and let people know what the topic is going to be, and then we're going to get right into your video
to kind of lead into it. So
yes, sir.
What most people are told is diversification for their investments really is not. There's kind of this. I mean, that's going to be a whole other conversation about how modern portfolio theory is bullshit. But people are often told this advice of, well, bonds are the safe asset and stocks are the risky asset. And when you're young, you can have mostly stocks, but as you get older, you should be positioned a greater percentage into bonds. And and they think that a mix of stocks and bonds is diversification. When stocks are up, bonds are down, and vice versa. Except it's not true. Bonds are like 85% correlated with stocks. They're both risk assets. When it's in a expansionary credit cycle, both go up. This is how Ray Dalio and his risk parity portfolio appeared to be doing so great. Is like, oh yeah, stocks and bonds are going up at the same time. But then, of course, he crashed and burned when credit contracted, right? And everyone's like, oh, nobody could have foreseen this coming. Well, you can foresee it when these assets that you're sold on, that those are just all risk-on assets. The entrepreneurial risk side of that is as a business owner, you're running a business that's generally going to be long on the economy, that when the economy is doing well, your business is going to do well. But if the economy does badly, your business is probably going to suffer along with it, some more than others, depending on what your market niche is. But then the received wisdom is, well, you should open up a 401k and encourage, yourself and your employees, and you get a tax break for doing it. Helps on your income tax, and otherwise you're losing out to inflation. So you'd better put it in something that can keep ahead of inflation. Except that all of those assets are, again, long on the economy, just like your own business. So when a crash inevitably occurs, and no one can predict when, but we've had 3 1-in-a-century crashes in 3 decades. So clearly something isn't working. Fat tail risk is presenting itself. And so just when you need that money the most is when it's basically not available, because you don't want to shoot yourself in the foot and sell when there's blood in the streets and the valuation is down, right?
Yes.
So to genuinely diversify both just a portfolio in general, but especially as a business owner where you already have a long on the economy major asset that you're, an active investment that you're running, your other diversifiers should be things that do well when the economy is doing badly. And almost by definition, those are things that are hard to know about and hard to get into because of the hot money phenomenon, or just so assets that are easy to get into tend to synchronize. And the reason most assets go up in a speculative sense is because of the money flows into those assets. So all assets tend to correlate based on how easy they are to get into. Also, all assets correlate in down markets.
Okay.
So the thing you want to be in is something that's hard to get money in and out of, and that also tends to do well in those down market conditions, because then that's your safety buffer. That's the money that's suddenly you're going to have liquidity when everybody else has lost it, and you're going to be able to take advantage of that. Mark Spitznagel is someone who's like very good on this topic, for example.
Okay. Well, I think that is a great segue right into your video. What do you think?
Yeah, let's do it.
All right, let's hit it.
You've been lied to. You've been told to invest in the stock market for the long run. The entire industry has convinced you that your hard-earned savings are actually investments, and that forces you to take imprudent risk with your savings. Everybody's basing this off of an amazing bull run, the largest in world history, on a 60-40 portfolio over the last few decades. Do you think that luck is going to continue into the future of your lifetime or even your grandchildren's lifetime? If we think about your hard-earned savings, you need those to grow, outpace inflation, and be there when you need them most, whether that's tomorrow or 100 years from now. So proper portfolio diversification will combine both offensive and defensive assets. As they say,
I'm going to read Uncle Gun's comment because it amuses me. If you don't have a weird, touchy uncle, I'm available at a very affordable rates. That's good to know, Uncle Guns. If anybody's lurking about right now, excuse me, rubber baby buggy bumpers, please remember to like and subscribe for the channel, and remember to leave a comment after the stream and let us know if you are actually getting something out of these financial streams, so we know in the future to keep streaming more of these.
Offense wins games, but it's defense that wins championships. If we look at a 100-year history of the stock index, there's going to be multi-decade periods where the stock market's either flat or underwater. The primary issue, if we look at a long history of stock market returns, is the idea of sequencing risk. Your life is not going to line up perfectly with a stock market chart. What happens if another one of these underwater periods lasts 25 years, and maybe that's during your prime earning years from 40 to 65? Or you need your savings during one of these underwater periods because you have a family member with a medical emergency. Typically, you're recommended a diversified portfolio. But when they show you that pie chart of diversification, it's actually only half of the pie. They're only showing you diversification of offensive assets. They're showing you stocks, bonds, real estate or REITs, private equity, and venture capital, and they show that it's proper diversification. The issue is all of those are the same thing. They're offensive assets, and they do great when we're in a long GDP environment where the party's continuing to roll on. But as soon as markets sell off or there's a liquidity event, the correlations go to 1, meaning all of those asset classes go down together. We want to take that ensemble of offensive assets and combine it with an ensemble of defensive assets to build a holistic portfolio. When we think about assets on the defensive side, what we're talking about is long volatility, tail risk, commodity trend, gold, and Bitcoin to hedge some of that fiat risk as well. True diversification requires that a portfolio is able to thrive in all of the 4 economic environments. Those economic environments are on the axes of growth and inflation. If we think about a 4-quadrant model, you're either going to have growth, decline, or inflation and deflation. This idea of combining all of the 4 macro environments has a long intellectual history. It goes all the way back to the Talmud, where they recommended a third each in business, real estate, and cash. But the seminal work was really done in the 1970s by Harry Brown, when he created his permanent portfolio. He looked at the 4-quadrant model and he created his own portfolio that can manage growth, decline, inflation, and deflation. In each of those buckets, he included stocks, cash, gold, and bonds to manage the 4-quadrant model. If we use Harry Brown's 4-quadrant model, that was expanded on by Ray Dalio of Bridgewater fame, where he just used risk parity to lever up the bond side of that portfolio. Now we have more modern interpretations, whether it was Meb Faber's Trinity portfolio or Chris Cole of Artemis Capital and his amazing paper on the Dragon portfolio. When we think about the 4-quadrant model and the way we apply it to the cockroach portfolio, We use stocks for growth, volatility for decline to make sure we can capitalize on those market sell-offs. We use trend for inflation. And by trend, we mean commodity trend following strategies that help us ride the rise in prices of commodities during an inflationary environment. And for deflation, we use income, which is similar to bonds or bond-like instruments. Where we think we've really improved on this 4-quadrant model is we like to use an ensemble of diversifiers within each bucket. We view that this ensemble approach allows us to get more robust returns from each strategy while also reducing the overall portfolio drawdowns. Outside of financial markets, another destroyer of wealth is massive devaluation of your fiat currency due to war or confiscation. So what we decided to do as a foundation to our portfolio is to carve out 20% of our collateral to purchase segregated gold and Bitcoin, which is no one else's liability and allows us to hedge some of those exogenous risks. That way we can manage that wealth during times of extreme stress. The other reason we believe in a layered ensemble approach to portfolio diversification is we believe that seeks to provide steadier returns while also lessening the drawdown over time. And those are the keys to really compounding your wealth over the next few years to the next 100 years. This is why we call it a cockroach portfolio. Granted, we know that's very visceral, but it's very alive and can sustain over any macroeconomic environment. And that's what we think about. We want this portfolio to not only outlive you, but your grandchildren as well.
So maybe it's my turn to ask you a question. How does that differ from most advice or thought on investing that you hear in general? You know, the kind of thing that people talk about at the water cooler. Oh. Star, are you there? Or is this my show now?
Your show now. I got booted out of StreamYard. That's what happened. I didn't put nothing off. I straight got booted out. It was freaky the other day too. All right, what did I miss?
Oh, just so as kind of a compare and contrast, you know, as a business owner yourself,
yes,
you know, no stranger to, you know, I'm sure you've seen an investment commercial on TV or had people discuss this kind of thing to you before.
Yeah.
How does this perspective differ from kind of the received wisdom that usually gets circulated around?
I think it's definitely far more descriptive and informative than most of the other stuff I've seen. Was that okay answer?
Sure. So
All right.
this is the engineer mindset of me is, well, why are things the way they are? And, you know, when I started working in a financial firm, that was a question I had after, you know, getting licensed and getting my feet wet and figuring out kind of how everything works. And then pretty soon after, I'm like, well, why does it work this way? And shockingly, very few people actually ask that kind of question. You know, they see it as like, and this is a mentality that has taken over basically everything since then too. I noticed this problem with millennials and younger generations more. Again, it's kind of this like post 2008 trauma response.
Yeah.
But a big part of that is, well, you know, the experts know we've already figured out the right way to do it. It's like it's a solved game, like Connect 4. Like we already know the steps to always achieve the perfect outcome. If you stick to following those steps, you're going to get a promised outcome. Now, ironically, millennials are falling down on their faces about this. That, yeah, getting a worthless college degree does not actually help you earn more money. And academia is a net negative ROI proposition unless you go into very specific fields like medicine.
Yes.
But and yet, in general, they stick to this. And this is also, we discussed at the beginning that there are very few asset classes that generations younger than boomers feel like they can get in on the ground floor with. And another one of them was social media. You know, everybody's getting their 15 minutes of fame. And they've kind of really took to heart this idea of like personal brands, right? That you can be an influencer. Now, it's kind of another niche that they were able to turn out. And that's created this scenario of what I've been calling marketing uber alles, that it's marketing to the exclusion of everything else. that there's the part of this great stagnation, or our version of the Brezhnev stagnation, or Neil Ferguson stole this from me, I'm going to say. He recently did that article and video on Are We Now the Soviets? That we've had, in terms of the real economy, about 30 years of stagnation. They had a alcoholism problem because they had state manufacturing of vodka. We have a similar thing with fentanyl and opiates. There's a sense that everybody is stuck in place, and there's no real growth or no real opportunity. And so, and why try harder if you're never going to benefit from putting in that work, right? That's why you have Lying Flat or Let It Rot or the Snail Girls, or the quiet quitting. So part of that is people don't see, basically people, they'll call it late capitalism or mature markets. There's all these euphemisms for basically this pervasive myth that everything that can be invented has been invented. I think this is a big thing that Elon is trying to push, and the PayPal mafia are trying to push back against, is that you need hope. You need to see that new things and creating things is possible.
Vision.
And we need to get, and having vision to get out of this rut. But without that, when people think it's all been done and everything's just about marketing to fight for a higher percentage of the pie instead of growing the pie, that's a big part of this stagnation as well. So coming back to how that affected the financial world, as it's also with fintech and kind of like this merger, having come from a technology background and going into finance and then witnessing, I'm not the only one. There's a lot of the finance bros who've had, one foot in each boat. And especially among the younger ones, the millennials, the kind of guys who their big ambition was to work at, Facebook or Netflix or all the FANG companies, because, their reputation rubs off on their personal brand so they can sell themselves better. They think that, it's all just in terms of like capturing market share. And what suffers is nobody is actually thinking about the thing itself. Like another example I use is there's always some new variant of selling flavored water in a can, or just straight up water in a can. What's that one that everybody thinks is such a big deal now?
Perrier or something?
No, it's I feel like that makes us sound like boomers.
I know, but I can't think of it.
Liquid Death. People think it's so brilliant to sell water in a can like it's an energy drink or like it's beer, but because it's all built on this brand of Liquid Death is so edgy or whatever. But it's fucking water in a can. Like you're not really doing anything new. You're just taking old wine in new bottles, and that has now completely taken over the way that most people think about the economy, and that's. So finance industry went in that too. In my own practice, that was another reason why I've been, kind of looking at the exit here, because they put everything so on rails and take away all of the I don't want to say discretion, because that actually has a specific meaning in finance, but they take away the advisory component of being an advisor to where everything is scripted. It's like when you call into a tech support line or a call center, and you can tell like they're on a computer that's giving them a decision tree of like, if this, then that, but they don't think at all. It's all been pre-programmed for them, right? And they're just reading it out and interacting with the person on the phone to get to that. Or like, choose an adventure story, right? Turn to page such and such. The whole industry has now become that. The idea of actually like thinking critically about a situation and coming up with your own solutions to that, or creativity in any kind of way, has basically been bred out of the industry. Everybody's just following a formula book. And
Sean, I think that's with most industries.
Right. Well, and that's why we're in our version of the Brezhnev stagnation. We're basically 1970s Soviet Union, where they reached a point where they said, we can't fix this, so we're just going to ride it out as is. It's why we have the competency crisis as well, is a big part of that. Is, well, what's the point in trying to create anything new if it's not going to make you any money or give you any kind of success or help you afford a home? So people just don't try, right? They give up. And same thing in the Soviet Union. You could show up to work drunk every day at the toothbrush factory because you can never get a better job. You could never leave your town. You could never change where you live. So people understandably become depressed. And at the same time, there's no penalty for failure either. It's this narrow band that we live in between a cap where ambition won't ever pay off, but also that there's this floor. I encounter a lot with younger people, especially with women, this pervasive belief basically that scarcity doesn't exist. People don't have a fear of like, oh, if I lose my job, I'm going to lose my apartment and I'm not going to afford food and I will starve to death in the gutter. They're like, no, there's government programs, or I'll move back in with mom and dad, or, like there's this sense of entitlement of like, well, things will never get so bad that my life will be in danger. So there's not really like a threat of failure either. It's this weird
Sean,
stasis.
hold the fort for 1 second for me. Can you do that for me for just 1 second? Thank you.
Yeah, go ahead. Oh, okay. So I'll continue on that rant then, I guess. So it's this stasis which is now why, so many younger people complain about like boredom is their number one issue. Like, I guess they don't have the creativity or the resources or the ambition to actually go do anything interesting. But at the same time, they don't face any real challenges either. Thorstein Veblen in Theory of the Leisure class kind of hinted at where this was heading, that when people no longer feel serious competition for creating resources, they're not trying to get the nicer car or a better house, or they feel like it's diminishing returns. Like if you have a car that works pretty well and is good enough, you don't necessarily need the Porsche or the Ferrari. I know there's kind of that it ends up being a status thing is where I'm going with this. So that instead of actually caring about the resources, they care about the status. In fact, I would argue we've gone through a sequence of steps where it began with people valuing the thing itself. Like if you're buying a car, well, I bought this car because I actually enjoy driving it. I could afford it. This is good for me. And then we saw a transition to where it became about status, where it makes them feel a certain way. Oh, if I drive a BMW or a Mercedes or a luxury car, it makes me feel luxurious. So instead of it being about like the practicality of it gets good mileage and it's easy to repair and it's good for me in real base level terms, now it's all about how it makes me feel. But now we've moved beyond that, especially due to social media putting this on blast, that now we're getting things not because it makes them feel a certain way. What they want is the feeling of other people envying and coveting what they have. So this is why women get $30,000 designer handbags and guys want the Bugatti or the Lambo, especially if we're talking about crypto, we're all going to have Lambos. Like if you've ever driven a Lambo, it's not really a great car to drive. First of all, Italians are very short. So if you're 6 foot or taller, your feet are all going to be crooked and the clutch is kind of crammed into the side. It's not a fun car to drive. But they don't want it to drive. They don't want to actually enjoy it. They get these assets because they want the envy and the attention and how many followers they can have and how much of an influencer they can be on social media. So now we've reached this tertiary where the things we're buying are completely unrelated to the function itself. And it's just this signifier for social status. And that's what people are most desperate for. But without the competency that underpin, we've hollowed out that underneath part. Oren McIntyre uses this great analogy of it's like a Jenga tower. We're not making new pieces to make the Jenga tower higher. We're pulling out pieces from the bottom. And if you do it carefully, the tower still stands, and then you put it on top, and now the Jenga tower is a little higher. But we're at the point now where we've pulled out so many bricks from the Jenga tower that the only way people think they can stack it up is to pull yet another brick. But it's getting very precarious at how many more bricks can we really pull out before the whole Jenga tower falls down.
I have a question for you.
Yeah, go ahead.
All right. So Selfmade is asking your thoughts on T-bills now. How do we combat the boomers? Self-delete them? LOL at Sean.
The day of the pillow. I do not advocate for any action such as that. That would be illegal and immoral. So don't commit the day of the pillow.
That would be immoral.
But
let's self-delete the boomers, Sean. Hey, Fatty, let's welcome in Fatty and his team. I think I'm getting rated. I'm not sure. Hi, Sam and Nino and Tony and T.O. and Jay Wells and other ones. I think I'm getting rated. Okay, I'm enjoying this.
All right.
Back to
So
the question.
I know that I've been on a podcast a few times with a gentleman who goes and a non who goes by the name of Stormy Waters, who works in I believe it's private equity or maybe it's venture capital. And he makes this argument to befriend the boomers. And in my experience, that doesn't happen. The boomers they're all space cases or well on their way to becoming one, just like Biden. They've been comfortable and complacent for far too long. They have very few incentives. Again, they don't want to train their replacements. They don't see the point in having legacy or, the world ends with them is very much their mentality. And yes, there's going to be exceptions. And I'm sure your dad listener at home is a great guy, but in general, this is how they behave as a group or a generation. I think it's just going to be, nature taking its course and, them necessarily passing away from old age that is then going to create the turnover. And it's going to be a rough turnover precisely because they've been unwilling to make any kind of preparations for that. When I first got into finance, a lot of that is retirement and estate planning and meeting with young families where the parents had passed away. And you always would hear the craziest stories of dad had coffee cans filled with money buried in the backyard, or money hidden in an old couch, or just crazy stuff that they never told their kids about it, never did any kind of planning, and then finally when they do pass away, it's like the world's worst game of hide and seek or something. And
yeah,
I think we're very much on course for that. Along the lines of what assets that people can get into now, creating high trust networks. I think we are also discovering that, I guess like letting the market decide or outsourcing all of our social interactions to be mediated by big tech is not making anyone happy. Dating apps are a radioactive wasteland, and same with letting, doing everything through social media. Go out and touch grass, make real friendships with people. And building high trust networks. We've part of the managed decline of whether you call it late capitalism or managerial socialism. The fact that everything is just so stagnant has also, just like we saw in the Soviet Union and under Chinese communism, it creates a low trust society where if somebody's bleeding in the street, everybody just steps over them and ignores them because they don't want to get involved. They're worried it's going to cost them something, as opposed to being a good Samaritan and seeing the social benefit of helping them out. Maybe it's a trick. Maybe the party is going to say, oh, well, you helped him and he was a political enemy and now you're a co-conspirator. So like the risk, and people are terrified of risk. Going back to the markets thing for a bit. Another social psychology phenomenon with the quantitative easing was a phrase I was trying to think of before, and the bailouts with the stock market is it's a lot like the euphemism treadmill, or that people don't know what real risk is. You will get this is another reason why I hate financial news, but people there's a 3% decline in markets today, and people act like it's the next Great Depression. We need to be way more anti-fragile and tolerant of risk and being brave enough to navigate risk. But because of the gerontocracy and boomers continuing to set the agenda, and because they're old and terrified of losing their money and want zero risk in their portfolio, the spillover effect psychologically to everything else is another contributing factor to this stagnation. Is that other than Elon Musk and the PayPal mafia, most people are terrified to take risks and have real change. That mood seems to be changing due to recent political events, and I hope that trend continues. But there's a real kind of depressive funk that we're trying to work our way out of, and that's a big
problem. There is. We got another real estate market to deal with too. Give me 1 second. I want to tell everybody who's watching right now that if you haven't already, please remember to like and subscribe. And if you would like to check out Team Fatty, I've just supplied his link into the chat. Please continue, Sean.
So I guess to try to answer that question, and I think, we don't necessarily know the answers up front. We're very much in a discovery process of how do we figure this out? But parallel infrastructure and crypto is one example of several, that, you know, hey, the infrastructure that boomers control is completely ossified and unusable by anybody, kind of including them. They're as trapped in amber as the rest of us. But it's clearly not working for us, and we're just going to have to invent new structures that do what we needed to do. We can't wait for the boomers to do the right thing.
Wait, are you blaming the entire downfall of the country and the economy on the boomers? Are we? Is that what we're doing?
So even though I'm being really hard on them,
Okay.
I'll walk that back a little bit. That I don't necessarily find like intergenerational warfare or like the blame game to be very useful. Like I would even set aside, it doesn't even matter who, regardless, the lay of the land, the field that we're playing on is in this state regardless. And what are you going to do about it? And the onus is on actually being creative, taking risks, doing things that haven't been done, and figuring and doing the hard work of actually inventing and creating ways to overcome these challenges. And, you know, crypto is one example of that. I don't think we should, it's not a panacea, you know, like, hey, that's good. You've solved 3%. We've still got another 97% of stuff that needs to get fixed. So we need a lot more of that creativity. But people respond to incentives. And I do, you know, my buddy Dimes reminds me of this all the time. I'm like, well, why are people so lacking creativity? He's like, because they're not paid to. And people respond to incentives. Like if you see no benefit for working hard, why should you work hard? You know, if you're,
well,
you know,
Sean, it's necessity is the mother of all invention, right? So if you don't feel like you need it, or you don't know that you need something, you're not going to like look to problem solve that issue. Let's summarize this last thought, and then let's take it a little. Speaking of large wealth transfers and stuff, let's take a look at this video after you summarize your thought, please.
So I guess I'll just wrap up that, you know, same way that if you're feeling depressed, and it's easy to say, oh, snap out of it or whatever. And obviously depression is a lot harder than that, but you've got to make the small moves. As Jordan Peterson said, begin with just making your bed in the morning. If you start doing the little things that you exercise those muscles and build up your capacity to do those things, even if it's in small ways, you know, just again, touching grass, making a new friend, doing a new activity, you know, even if it's something as cliche as hitting the gym or learning a martial art, like just those little things will lead to other things, and the dominoes will start to fall, and then we can actually get something done.
Yes, it's called opportunities. You're creating opportunities for yourself, which opens up avenues for success in your life. Woo!
$3.5 trillion worth of wealth between generations over the next 20 years. Baby boomers have accumulated most of this wealth and are already starting to distribute it to their children. Well, joining me now is Kirsten Taylor-Martin, partner and national head of family business consulting at Grant Thornton. Kirsten, thanks for your time.
Thank you for having me.
Let's just explain this wealth transfer that's currently happening, and why is it significant for our economy?
It is significant for the economy because at the moment, only 12% of family businesses successfully transition to the third generation.
Correct.
And only 1 in 20 families transition more wealth than what they inherited. So if we don't get this right, the stakes have just got a whole lot higher with 3.5 trillion transferring. For the economy, we could have a lot more businesses go bankrupt, and that could cause unemployment because family businesses currently employ 50% of the Australian economy. Also, with that level of spending, it's going to keep pushing up higher inflation. But for us, the biggest issue is the family wealth is just going to start to decrease.
Oh my goodness. Can somebody tell me why most women in the financial markets are ugly? No? Somebody? Anybody? All right.
Increase unless we really start to work on the financial acumen of the rising generation coming through.
Yeah, what point does a family start planning its wealth transfer process? Is it when the head of the family is getting close to death, or does it happen a lot time before that?
This is the problem, is that people aren't planning. So in many situations, we're finding out the outcome when they're actually reading out the will.
The will.
I'm going to use an example, but The Gentleman was a fantastic example. So with that series, the eldest son thought it was coming to him.
Yeah.
And then they read out the will, skipped a whole, well, didn't skip a generation, skipped to the younger brother.
Yeah.
And as an audience, you kind of wonder, why did Dad make that decision, and then you see the eldest brother dancing as a chicken, and you think Dad knew.
Yeah.
And we see that a lot as well. So we don't so much see that they miss like a sibling, but what we are seeing is they're skipping a generation.
Right.
So I worked with a client, and he was at his daughter's wedding, and the father of the groom came up and said, "My son married up." The next day on the golf course with the solicitor, he rewrote his will, skipped a whole generation because of that one comment that was made. So this is what we're seeing.
Oh,
and
wow.
when that happens, they usually put someone quite trustworthy to help. And I can say in all the examples where they've skipped a generation, the wealth has definitely increased. But as you can imagine, so have the lawsuits, and the harmony but in the family just gets totally disrupted.
Oh, yeah.
So what we'd prefer to see is start planning earlier, start the conversations now, like what's the future going to look like, and how can we start to get things in place now so that we can actually achieve that outcome, but also helping improve the financial acumen of that younger generation, because they're going to get so much wealth that we want to see grow, not diminish.
And what about times when parents
I'll
sort of say,
there for a second, because now I can't necessarily speak for Australia, but I'm pretty sure actually Australia is not too far off from the rest of the Western world. It is not really about skipping generations. What's really happening is boomers are selling out to private equity and large institutions. One is kind of a fuck you to their kids. I earned it, so you should, I paid for your college degree, and college degrees are everything. So now you should just be able to, make it all yourself. Why should you inherit anything? Which is never how families have ever worked until modernity, right? It was always about, like Game of Thrones style, that, doing it for the family is everything. But boomers are the broken link in that chain, where they're saying, no, everybody has to start from zero, from scratch, and hopefully society is in a position to be able to make that workable, which it's not. Or it's to go to NGOs or something that's going to stroke their ego, or again, it's a status thing. Basically, most boomer parents hate their children so much that they'd rather give their money away to strangers than give it to their own children or even to their grandchildren.
Yeah.
And all that means is that it's going to, BlackRock or Blackstone or the government or to hospitals, because they're going to linger in a nursing home or, a skilled nursing care with dementia for 30 years and eat up the whole inheritance. So, boomers are serious about when the world, the world ends with them. They have no sense of legacy. Whatever wealth they, inherited themselves or created in large part because they were given all kinds of assistance and financial grants and government programs when they were young.
And government contracts, yes.
But they're just going to liquidate all of that. I mean, so again, going back to working in, like the financial advice world, in the whole tenure of even when I first got started, it is very popular to pitch to boomers, you want to die broke, spend it all. You worked for it. You worked hard for this money.
You
spend
deserve
it all in your retirement and die with zero in the bank account. Fuck your kids. That's your
right.
money. It's
those
just
little
yours.
bastards.
And
they can get it on their own.
Yeah. Right. As if they created a world where there's so much economic opportunity and vitality in the world for their kids and grandkids to go out and get that, right? Like, not only did they completely strip mine the world that they lived in, but now they're gonna throw it all into the garbage incinerator on their way out. But it's not all the boomers' fault. It's not every boomer, but it's always a boomer.
Okay. Well, Selfmade says, man, Sean is call out full on war on boomers. LOL. And thank you to the Untouchables who've hit the house. Thank you so much for liking and subscribing. We appreciate you. And I have dropped Fatty's link is in the chat. We'll drop it one more time. Go check out Fatty and his channel. Anything else you want to say about the evil boomers?
Well, so it's more like Christopher Lasch has a book, The Culture of Narcissism.
Yeah.
Whether you call it, they're evil or just they're self-obsessed. Yeah. I mean, they were raised in a time of plenty in the 50s, and it made them. I mean, I think that's maybe the origin of this delusional fantasy of a post-scarcity society began. And then I think they then raised a generation of millennials and reinforced that belief among them, as if we're past the point where we need to still worry about creating resources. And especially then when most of these people have never paid a price for failure. They've never felt like they were genuinely under the threat of being homeless or hungry as a result of not working their asses off to generate resources. The competition just shifted to status anxiety, which again, boomers have in spades, and acute competition over social status as opposed to creating resources. And there will be some kind of day of reckoning for that, in the same way that eventually the Soviet Union became so decrepit and unable to do anything that they couldn't even grow food and had empty supermarkets, and then they just had to cry uncle one day and be like, you know what, this utopian vision that we've had for 70, 80 years, whatever it was, we just can't bullshit ourselves anymore about this. It's over. But I also think we're probably at least a decade or two away from that crisis moment.
Very good. Back to the video.
Hand over the family farm or the family manufacturing business to their kids, but the kids don't want it. Like, what happens then?
Well, that's an interesting scenario, and we are seeing that businesses are going up for sale. Because like, as much as we want to keep family businesses in the family, if the family don't want it, maybe it is better off to sell and to have the wealth and then work out what does the family want to do in increasing that wealth. But the other thing that we do see is sometimes they will get someone external from the family in to run it, and then the family take a different role and they're owners, so they receive profits, but they're not actually running the business. The biggest problem we find with that is it's very hard because, as you can understand, families have like certain values that they run their business by, and they want to create a culture. Bringing someone in that's not a family member to have the same family values, that's the hardest bit to try and capture.
And are there any specific industries or sectors of the economy where this wealth transfer happens more often or more commonly than others?
The one that we're seeing is having like the most issues with it at the moment is agriculture. And the reason for that is their biggest asset is often their farm. And in many instances, say they have 3 children, there'll be one child that lives on the farm and runs the farm, and the other 2 might have totally different careers and have nothing to do with the farm. And the parents usually want to keep things even, but want to keep the farm in the family. So it's how do you actually achieve that? So what we actually try to do is there's a lot of strategies you can use to actually make that successful, but it's important to speak to every single family member and get a really good understanding what they want so that you tailor the strategy to achieve that goal.
We don't have much time at all, but the younger generation, just really quickly, what are some challenges they're facing?
There's a couple of challenges. Firstly, they've got really big shoes to fill because the baby boomers, a lot of them are the founders or they've gone through real hyper growth. So,
Kirsten, I'm sorry, we've run out of time,
right.
But that is a very good point at the end there.
Okay, so let's say hello to the chat one more time. Doris Meyer, nice to have you in. RNTY, nice to have you back again. Nice to see you. And then Mel stayed fitted. Adrian and Fatty, if you're still here, I'm still plugging your channel. Okay. Let's queue up this last video. And then we'll start doing an outro. And then we'll call it an evening. What do you think, Sean? Sounding good?
Yep, sounds like a plan.
Sounds like a plan to me, too. All right, so we're going to do this new video on the great wealth transfer. Who's getting the money? So, Sean, evidently when they're talking about skipping the first generation, they're talking about skipping their kids, right? And going right for the grandchildren.
I don't think it's even them. Really, that, boomers have a mentality of faith in institutions and managerialism, and no faith in family or kids. It's kind of this hyper individualism, or rebellion, right? Very like kind of a Woodstock mentality of, break out of existing structures and tear them down. And but just kind of this ephemeral, well, society is there, and it doesn't work. But that's still the mentality they have is, they see it as, well, they did it on their own, and they're just going to give it back into the ether as opposed to actually directing it to their family.
What do you think is going to be the biggest distinction between them and the Gen Xers?
So Gen X is in a very interesting position that they've never sought nor been offered power. Leaning on the fourth turning a little bit here, even though that's maybe a little like woo-woo-y. I think they're going to be more of like the consigliere role. So again, this is going to be a very rough transition. Describing what's on the other side of that transition, I think, is almost impossible to say. It's like the other side of an event horizon. But the Gen Xers, grew up through a lot of self-management and cynicism. They're survivors. They're the cockroaches of the cockroach portfolio, so to speak. So they're acutely aware of, well, what works and what doesn't, and being practical and pragmatic and knuckling down and solving problems and expecting to get no recognition or praise for it. You got to do what you got to do. And as these younger generations come into younger power and start to create the institutions that are going to replace the old ones, I think Gen X are going to be in that consigliere role of, they're the old heads. They remember what used to work and what didn't. They have the living memory of, what actually happened, especially since we've kind of entered this age where there's a lot of censorship and distorted history in the history books. We're starting to break down the boomer truth regime as far as like official narratives, but there may still be a lot of that. So talking to a Gen Xer of, well, how was it really when you were alive, when you lived through it? I can speak to, I remember before the Great Awakening. I remember what life was like before 2014. And it was in many ways culturally the polar opposite of what it's been ever since. And there's a concerted effort to memory hole how life used to be before then. Or going back to the 90s, how incredibly optimistic people were in the 90s compared to after the 2008 crash, which has created this like psychic trauma with everybody.
Yes.
So just having that memory of like, I was there, Gandalf, 3,000 years ago. I think that's going to end up the role of the Gen Xers, to be kind of the consultants of, remembering what it was like, what worked, what didn't, separating truth from propaganda.
I think you're right. We've got some big shoes and roles to fill now, don't we? And so here we go with the video.
Under $84 trillion of assets in what's called the Great Wealth Transfer. Today, let's go into what will happen and perhaps more importantly, how you can best prepare yourself. And the very first question is, how did baby boomers even accumulate so much wealth? In 2024, baby boomers owned $78.5 trillion in assets, which is 51.6% of total wealth in the United States. This is compared to 9.4% owned by millennials and 25.8% owned by Gen X. And it's pretty normal that older generations have more wealth than younger generations. They've been in the workforce longer and have had more time to compound wealth. But a study shows that it's more difficult than ever for millennials to build and maintain wealth than it was for their parents at the same age. In their 30s, the average baby boomer had a wealth of $140,346, 25% more than the wealth of millennials around the same age. And in the same aspect, boomers held 20% of their wealth in their 30s, while millennials hold about 3.5% at the same age. So again, the question is
that's
how?
horrible.
A lot of this can be contributed to luck and real estate. First, real estate prior to the 1980s, housing wasn't as it is now with prices continuously soaring. Instead, it was just a purchase for raising a family, having a backyard barbecue, and it was just a place to live and not an investment. And housing prices never grew faster than wage growth or stock market returns. Simply, it was just a way to store money. But in the 1980s, as mortgage rates began to drop, the perception of the housing market changed. It was easier for people to receive cheaper loans and buy their homes in American dream. And at this time, baby boomers were around 20 or 30 years old, which was the perfect time to buy a house. And traditionally, the rule of thumb is that there should be a 3-to-1 ratio between home price and income. In the 1980s, the median home price was $64,600, while the median household income was $21,020. It was a perfect 3-to-1 home to price ratio. And fast forward to today, that nice 3-to-1 ratio is far from reality. Today, the median house price is $412,300, while the median household income is at a snail's pace and estimated to be at $78,171, which gives us a 5.25 to 1 ratio. And again, this is due to a shift in how people viewed real estate. It was no longer just somewhere to live or keep your money. It became something to invest and watch your money grow. And because of this, the disconnect between wages and home prices widened much more so in the 1980s. And since the 1980s,
Rent alone is pretty much half your income every month alone. What do you have to say about that, Sean?
So yeah, this is the problem of financialization in general. This is a big part of my book is on this as well, but this goes back to the early 20th century, how treasury bonds were invented originally as Liberty bonds. And basically part of this managerial regime of treating every asset as if, instead of it being for utility, that it's for speculative investment. So we've covered this before, and hey, am I excited that Bitcoin is reaching all-time highs or something like that? It's like, on the one hand, well, yes, but on the other hand, it is just another form of asset speculation of as the supply of money and credit expands, it's got to go somewhere. It doesn't go everywhere uniformly. So can you pick the places it's going to move into faster relative to everywhere else? But none of that is productive. And Richard Werner, as an economist, is actually very good on this point. I'll try to sum up his work very succinctly since we're at the end here. But basically, anytime there's loans, and banks are what create all the loans, and under this fiat system since the 1920s or 1910s, that's the source of all money creation is actually through the banks. And anytime a loan is created, it can go into one of three places. Either it goes into consumption, buying stuff that just gets used up. And that's where you get inflation in the way most people think of it. That's when the prices of consumables like milk and eggs and rent and energy go up, all else being equal. Or it can go into capital expenditure. It could go into if you own a factory and you need to expand your production capacity so that you get better economy of scale, or maybe you're making cars with one kind of robot and now it's 10 years later and there's way better robots that can make more precise cars faster. That's normally where the engine of real economic growth in an economy. But there's also a ton of entrepreneurial risk with that, right? Maybe it's the wrong kind of robots, or maybe you're making the wrong kind of cars, or people don't want what you think they want. They want something different. So you're taking on a lot of risk, which is supposedly why entrepreneurs are rewarded when they get it right, is for taking on that risk and figuring it out. Yes. Then there's this third thing of asset speculation. And there's a real trick to this where, the banks are going to create a loan. They're going to ask for collateral. The thing they're investing in is also the collateral for the loan. And because the collateral is basically the same amount exists and more money is going into it, it's pretty much deterministic that the notional value of that asset is going to go up because you just created the money that's going to be invested in it. And this is what boomers have invested in, right? They invested in housing. Yes. They invested, the ERISA came out and suddenly everybody had mutual funds or invested in stocks through work. And it's all this credit creation got dumped into these assets that they've been able to ride a bubble up. But none of that is productive. It's all speculation on, I'm buying it low now and hoping it's going to be worth more later. And you end up with a resource curse that you're crowding out. Yes, go ahead.
Do you know what time it is right now?
Time for me to get a watch. No, what time is it?
No, it's 9 o'clock. And do you know do you know where
you
your
turn
children
back into
are?
A pumpkin?
Yeah. Do you know where your children are right now?
Right.
9 o'clock.
Last time, no.
I know, me either. Thank God. I need a break. No, I'm just kidding. All right, let's go back to the video and then we'll start finishing up.
Yep.
80s, housing affordability has fallen to its lowest levels. Baby boomers who purchased a house during that time have been able to profit and bring in significant gains that continue to grow.
And Doris Myers, welcome in again. We appreciate all the cougars and bring your friends, please.
Grow even today. And next is the stock market. Before your Robinhood app or even the Wolf of Wall Street, the stock market prior to the 1970s was a shady club that only a few were able to get into or even access. And most people thought it was a scam until 1976, when John Bogle created the first index fund, which made it easier, more accessible, and cheaper. for people to invest their hard-earned money into the stock market. And in parallel, technology saw rapid advancement as the first personal computer in the 70s and the internet in the 80s brought the stock market even closer to the average person. You no longer needed a fancy degree from an Ivy League or a finance license to invest in the stock market. And during this time, baby boomers thrived. Not only was technology in the perfect place, but
I'm going to read Uncle Gun's comment because, again, it amuses me. Cougars are here? Well, hello there, ladies. Fancy a dance with a sailor.
baby boomers were at the optimal age and in the peaks of their careers and therefore potential earnings. In 1982, the Dow would gain 42.4%, and even though the bull market would end in 1987, over the 20 years following, the Dow gained more than 1,000% overall, or 11.6% per year. And baby boomers went through their own struggles and worked hard in their own right. But a lot of it too is simply being in the right place at the right time. And similarly, how Buffett very much contributed a lot of his success to not only his research, but also being born and raised at the right place at the right time. In the United States, and the son of a congressman and businessman. Luck and timing.
Romano says he is a pimp and he loves cougars too, and he probably has a nice supply, so contact him later. No, I'm kidding.
So what does this mean for the great wealth transfer? Well, before we go on, if you're enjoying this video and finding it useful, please make sure to like and subscribe. It'll help this channel a lot. Thank you very much for watching.
Thank you very much for watching and educating us. What did you feel about the rest of that video, Sean?
Yeah, I think he's on the right track.
I think so too.
Yep.
Did you want to say anything else about your book?
Yeah, just I guess keep watching this channel. We'll get that info out, especially as soon as it's ready. But yeah, it's exactly these issues that it's going to be a rough transition. Nobody is going to save you, and the boomers aren't going to do anything about it because they're already content and have no reason to do anything. So it's on us, right? If you're going to believe in anything, believe in yourself and your ability to figure this out.
Yes, adapt or die, in other words.
Yep.
Yes. All right. Well, if you don't have anything else you want to say, then let's close up the stream. Are we ending on that note? Okay.
Yeah.
Yeah, let's end up on that note. All right. Well, my panel guest and financial advisor, Sean Wieland, right here with me at School of Thought. He has a book coming out. Stay tuned for that and more with him. We're going to be doing more Financial Thursdays. Greed is good. I want to thank everybody for staying here with me at School of Thought. If you don't mind, please leave a message and comment after the stream and let us know if you're enjoying this and if this is also helpful to you so we know where to head in direction-wise in the future. So I want to wish you the rest of your work week tomorrow. Thank goodness it's Friday, right? So have a wonderful end of your Friday tomorrow. And we look forward to seeing you again here at School of Thought. I'm your teacher again, Star Nova, and it's good to have you here. And we will see you again soon. Bye.
Thanks for having me. See ya.
Anytime.